Good morning, everyone. I'm Vince, and this is the GoldFix. Um, we're going to go through a couple things today. We're going to go through complexity collapse, which I think is going to explain the Middle East a little bit better for everyone in a nice big picture sort of way without bullshitting you. Uh, you can see silver's on the screen there. I'm going to touch on that for a second. There's more to come on that. And we're going to talk about a couple other things. But let's start with the markets. Oh, first of all, silver. This report I got a couple days ago, and it's very current. Um, and well, I read through it once. I'm reading through it again for GoldFix Premium readers um, to write something up on it. And I did it. I did my due diligence reading through it, and I showed it to Chris Marcus at Arcadia Economics. And Chris, you know, he's the silver guy, right? So Chris looked through it and he had a comment. He said, "Isn't he said a lot more than what I'm telling you, but we want to get him to say it himself because it was just really insightful." It's like, isn't it interesting how in this report every sector is buying silver except investors, and it seems that if investors don't buy it, silver doesn't go up. What's up with that? Considering that everyone's buying silver hand over fist for solar, it goes through the whole industry. Solar, how much silver is needed? Electric vehicles, and then it just keeps throwing in there, but investors aren't buying. Well, that's implying something. Anyway, I'm not going to give away what he said, except to say that isn't it interesting that if investors don't buy, it doesn't go up. But if everyone else buys more silver than exists on the planet Earth, you can't get the price to go up. So we'll try and get him to talk more on that. If you're listening, Chris, I think your people are going to want to hear that. It's it's so true. All right. I'm going to leave that up there while you're looking at the markets. The dollar is down 9. Bonds are slightly stronger. Stocks are up 22. The VIX is giving back a little bit of everything that it rallied yesterday. Gold is up 9 and change, was up about 7 an hour ago. So it's really working its way higher now. See how it acts at 8 o'clock, the 8 a.m., slam. Silver's up 8 cents, lagging. Crude is up 33. Natural gas is down 4. Bitcoin and Ethereum are down about 73 basis points on average. Soy and corn are up 50 basis points on average. Copper's down 20. There you go. That's probably why silver's lagging a little bit. Platinum, palladium are up though, so that doesn't make sense. So that whole theory is wrong. Let's just say that nobody wants to invest in silver, like the bank report says. Anyway, excuse me, I'm getting a little bit of a cold. All right, what do I have up there? I have a chart I just want to share with you. There's a report out, and I would, we wrote up something on it. Let's see if I can find it. There it is. Real wages may be fake. Okay, that's the headline, and here's the chart that matters on the report. There's a lot of other charts in there, but basically what you feel is right. Why does everybody think the economy is weak, but the data shows it's strong? And at some point, you get the impression that you're being told it's something it's not. And a bank out there has done the math, and you may all feel that PCE is not really a good indicator of inflation, but never able to put your finger on why that may be true. Well, this bank says, here's some of the other measures, and you'll notice that PCE, which is I guess that's seafoam green, light green, is significantly higher wages. This is a wage chart, higher wages than every other measure on Earth that's acceptable to use. So kind of convenient. Anyway, take a look at that article if you're a subscriber. This is because I'll tell you why. Because this is the first time you see it, and you're going to see it a billion times more. I hope, I'm sure Zero Hedge is going to write something on it, because this is, when you look at this in the context of the jobs revisions, the GDP, the jobs revisions lower, the GDP revisions lower. The books are just all cooked. It's pathetic. We're a banana republic in that respect. Anyway, I would recommend you read that. All right, GoldFix. Oh, sorry about that. I'm on the wrong page. Okay, there we are. That's the clean version. Can we go through the markets now, Vince? Yes, we can. Stock longs get worried about their downside, complexity collapse. Yesterday's activity, we did that. Commodity stocks, yesterday's activity. Okay. Retail sales came in strong. Beige book points to a soft landing for the U.S. economy. One more sign the Fed does not need to cut rates aggressively this year. Okay, so data, retail sales came out strong. The economy's doing fine. Beige book came out implying that a soft landing is in the works, also implying that we're probably not going to have to ease anytime soon. U.S. equities traded on Wednesday. You can see that. NASDAQ lost 59 basis points. The VIX increased 6.86%. I keep saying don't pay attention to that, right? Because that's my own little fetish. But the bottom line is I know a lot about volatility if I know anything. And I'll tell you right now, the market's changing again. And that's what we're going to talk about. Here's today's data. Here's the news. I'm going to leave the news up there while I'm talking about stocks, right? Look at the Middle East news while if you're on a multitask. What's happening now in the stock market is, I think, significant. Once upon a time, before there were zero-date options, and before the Fed manipulated the market too much on the volatility side, people used to buy puts. By people, I mean hedge fund managers used to buy puts and sell calls. And that was normal stock market behavior. So they buy puts and sell calls because they were worried about losing money for clients, not about making money, because they're already long the stock. And when the market dropped, those people who didn't buy puts would panic and buy puts, and volatility would expand. And that's something called stochastic property of volatility. And then in the last several years, probably starting during the stimulus, maybe a little before then, you started to see the market people were not buying puts like they used to. And portfolio managers were just not worried about the downside. They're like, why buy insurance? Why buy protection? It's going up. And, they were right for the most part, except during COVID itself. Okay. And then people started buying calls. Oh, I think it's going to go up. I may as well buy calls. And then zero-date expiration options were created. It's like, I can buy calls that don't have a big skew implication for your options geeks there, right? So, just a little bit of premium, buy some calls. It's a nice little lottery ticket. Anyway, and before you know it, the whole market starts shifting from what's called a put skew, volatility blows out on the way down, to a call skew, volatility expands on the way up. And the market got a little bit confused. All right, so there's your history. Here's what's happening now. In recent weeks, coincided with this whole the Fed may not ease. The whole talk started. The skew, which has been relatively flat, started to move towards the puts. So the calls started to go down and the puts started to go this way. The calls started to go down. You have to look backwards. Calls started to go down, puts started to go up, which is a sign. It's a tell. It's a fact that if the skew is going up on the put side and down on the call side, that means people that are long a lot of stock are buying puts and selling calls. That means they're concerned about the downside. Is that bearish in and of itself? No, it is not. It's a sign that they're committed to the market and they want to buy insurance. However, and this is the big point, for every one guy out there buying puts, there are two that should be that aren't. They're speculating that it won't go down still, which means if this market goes down, stocks, you're going to have some serious acceleration. Now, again, going back to the option wonk stuff, dealers, guys like myself who make markets for these producers, for these fund managers, they need to buy puts. Where they buy them from? They buy them from the dealers. They buy them from me, right? Well, dealers for the past year have been really long puts because they weren't selling as many as usual. They had a big inventory of puts. Well, now they don't have a lot of inventory of puts. And now the buyers of puts are fund managers who ain't going to sell them out. They need them to protect their portfolios. And the sellers of puts are the dealers who need to buy them back if the market goes down. And for every one of three people out there buying puts, that's a fund manager, Two of them aren't, and they're going to want to buy puts. So I think if this market goes down, you're going to see good old-fashioned put skew volatility return, and you're going to see this market start to clip in standard deviations, not in small moves. End of the world? I'm not predicting end of the world. I'm just saying if there's a reason for this market to go down, you do not buy the first dip this time. That's it. Wow, trying to cover a lot here today. Gold, right? Gold, nice. $11. Good. Okay. I have a couple lines here. I redrew some lines. Start with the daily. That upside line I have here, useless. This line still useful. Going down, what did I say, right? Well, it's on the daily, right? So here we are. We're below this line. I'm going to leave it there. And we seem to be creating a new channel now. It's pretty obvious to me now. I had a line up here I took away. All right, so on a daily, what you're looking at is you're looking at a market that is ratcheting lower, getting overbought and slammed. Remember that hourly one I showed you? This is a daily one, getting overly, I'm sorry, I showed you the daily one. Bought, sold, and now it's back into this range. So there's selling, or there's a lack of aggressive buying, if you want to look at it that way. Here's the thing that is the most troubling. This is part of a system that I use to tell me if the market's going to trend. And according to this, the market should trend lower for the next 5 days unless it gets above 2026.10. Okay, so we're up today. You want to be bullish to trade long for the day? Go for it. I think that's probably the trade. You want to be bullish to trade long for 2 weeks? Might not be a good trade. I would wait until it gets above 2026. However, this is a nice little retracement, but I do have a trigger to just not be speculating long unless it gets above 2026. And the same goes for, well, it doesn't go for silver. That's always a good sign. If this is not doing the same thing, then gold may be a buy. All right. On the hourly, the Bollinger Band thing I look at, you should be long gold from, of course, it's after the fact. You should be long gold from 2012-16. So if you're long now and the market's trading 2015-90, you would buy it now with buy it right. Here's what you do. You buy it right now with a stop at 2012-16, right? I'm not saying to do that. I'm saying I'm not in the market right now. I'm in the market, but not aggressively. You should be long now with a stop at 2012-16. You're risking $3 to make $6, which would put you up here. All right. If it gets below 2012-16, all bets are off. We're in a range. It could work its way lower again. That's it. The collapse of complex societies. I'm going to do a separate one on this, but where's that? Look at the news out of the Middle East. U.S. Central Command said a drone launched from Houthi-controlled areas in Yemen struck a U.S.-owned vessel, yada, yada, yada. U.S. military also announced it conducted strikes on 14 Houthi missiles. Yes, this is completely my words. Iran blew up something in Pakistan, and then Pakistan retaliated. Lebanon's foreign minister said a war on Lebanon is not easy for Israel and will be a regional war. Pakistani's armed forces are on extremely high alert. Okay, you know what this is? This is a regional war. It's not going to be a regional war. It is a regional war. Like Vietnam wasn't a war because we didn't call it that. This is a regional war. And it's getting worse. It's not getting better. It's a slow cancerous spread. Maybe the U.S. wants that. We get Pakistan and Iran to fight each other. The kids start fighting in the schoolyard. And the United States says, screw it, we're not going to help you. Let's see how China likes that. Let's see how Russia likes that. Look, if you think America's doing this on purpose, the result would be you don't want us to help? Fine, you handle it. Maybe we want Israel to do what it's doing, cause a little chaos, a little Joker chaos. On the flip side, if we don't want this to be going on, and that's equally possible, we may want this to be going on geopolitically. But Biden doesn't want it to happen because this is going to ruin his election. If oil goes up, if this spirals out of control, mean, how could it not be spiraling out of control? It's already a regional war. Anyway, that's just my take. But this is all tied to the collapse of complexity, which I'll get into. It's 7:34. Have a great day, guys. See you soon.